Welcome to FinTech CTO Talks, the podcast that goes behind the scenes with the tech leaders, solving the challenges and rewriting the rules of finance. Money moves fast. Does FinTech keep up? Let's find out. Ami, sit down with CTOs, engineers, innovators who are making the finance sector smarter, bolder, more connected. Together, we will explore the platforms, the codes, the bold ideas shaping the future of financial technology, and yes, making it a little fun on the way. Today, we are joined by Hemant Patel, CFO, CSO, and a seasoned chartered accountant with over 25 years of experience as a strategic finance leader. Hemant has led large finance functions, has worked across a diverse range of industries, including fintech, fast-track payments, mobile wallets, ATMs and POS, securities, NBFC, MIFs, media, advertising, logistics, and professional services. He has been instrumental in scaling businesses with revenues reaching up to 400 crores in rupees and managing organizations with a workforce of more than 300 people. Hemant, it's a pleasure to have you on the podcast.
Thanks a lot. It's my pleasure too. And I would really be appreciating such kind of initiatives where people can come, they can share their experience, and maybe it can be helpful for the audience.
Absolutely. So, like today, Hemant would be talking about what investors really look for before funding a fintech startup, from a CFO's perspective. So, Hemant, my first question to you is, India's funding has dropped from $8 billion in 2021 to $2 billion in 2023. Like, so from, CFO's lens, what has specifically changed and how are investors evaluating the risk and return in that period?
Surely. So, see, ideally, the way we see things is the one reason is that the investments is getting matured. The perspective is getting matured in last 5 to 10 years. Pre-COVID, things were different. The valuations were looked at a very higher level. There was not much of stress on the bottom line.
Correct.
Okay. And that's how things were highly valued. The market was big, but I think the addressable market was wrongly captured or miscalculated. And ultimately, that has led to a scenario where now people or the investors have realized that profitability is going to be the biggest requirement.
Correct.
Secondly, the compliance and governance model, which is there in the company. So these two things have become the most important thing now. 5 years back, probably finance was not sitting at the front end. Maybe you can say sales, marketing, business, or product and technology. But
Correct.
ultimately, it has to be driven with the numbers and the
Absolutely.
accuracy, and the investors are looking at ROI. So that is where pre-COVID, post-COVID, and the kind of IPOs which have come, the reality is now established that the basic fundamentals of business, which is the bottom line or a profitability, can never be changed.
Correct.
And that's how it is moving ahead now.
Okay. So, like, in your experience, like 25 years of your experience across fintech, NBFCs, and payments, what's the single biggest mistake founders make when they walk into an investor meeting, thinking, that their financials are investor ready?
Yeah. So biggest mistake which what I have seen from the founders is that while they are good at creating a product and a business, but they do not have a maturity, you can say more on the finance side.
Correct.
or how the business will scale up. And the third thing is, will they be ready or in a position to dilute their authority, ownership, control, or decision making on a bigger scale with the new investors or a new management team or a new board of directors? Autonomy. So that is something which people don't perceive, and that can change the whole dynamics. Because the moment there is someone who has put his money, he's going to drive things.
Absolutely.
Otherwise, prior to that, the founder has his own time and the way of doing things, which is not going to be the case once you get the funds in place. So that is something which I think now the founders are understanding and getting mature to that level. That's the best thing which is happening now. That's why they are not raising funds very fast. They are trying to be patient, and they have understood that you need to scale up with a profitable business and
Correct.
getting driven by the finance. Yeah.
Okay. So, beyond P&L, what are two, three financial statements or internal reports, that are serious investors always ask for? And the most important, that startups are not prepared even today, or it can be back then also, if you could share.
Yeah. So mainly you can say what type of customers are coming into the business. What is the customer acquisition cost? What is the life cycle value of the customer? Thereafter, what is the quality of services? Then, what are the additions, deletions in the customer? What are the reasons for losing that? So these are the kind of factors of metrics which is very qualitative, which actually tells you the business, how is it going. Otherwise, what happens in the company, people only try to see what is my sales, my revenue, my cost, and profitability. But
Correct.
what is the composition of my sales? How is it getting derived? What are the factors which actually drive my sales? So this is something which is very important for a startup and even any other company to actually get deep dive into those very specific micro level data points, have a very good dashboard, start monitoring it on a daily basis so that there can be a preventive action taken. Because the more you get data, information, and the actions are taken, ultimately it takes care of the overall structure.
Okay. So, like when you're talking about this, there is unit economics also,
Yeah,
which gets thrown out a lot.
right.
So, what does a CFO actually look at to know if a fintech's unit economics is, are real, or versus just, presentations, or just
Mhm.
layers, or just numbers? How do you identify?
Right. So see, unit economics works when you are seeing things at a very, you are able to measure things in a unit. Let's say a quantity or a size or a unit one, or in fintech, the main, you can say a transaction.
Hmm.
What are the metrics you try to see that what is my throughput or a gross transaction value? Then what can be my income rate? What is that value? What is my direct expense? What is my contribution or a margin? And then what are my overheads? And how do I break even? At what volume I break even? What is the market right now for this particular product? How much I can do in a month or a year? And how is it going to pay back? This is how we define the structure. We bid for the contract by the pricing and we go out. But then after a period of time, the reality starts changing because there were some factors which were not calculated or not
mm,
seen, but
mm,
now that has happened. So it's very important that once you have set up the model, a unit economics level model, when the actual reality happens, you capture the data and you keep revising your unit economics to understand what is the variation, because that will help you either to revise your pricing if that is open.
mm.
Otherwise, the only thing that left is that you have to revise your costing. And if still that doesn't work, then you have to live with that loss if it is going to. And then you have to ultimately consider that loss not as a loss, as an investment. It's
Okay.
as good as an investment which you are doing. And the moment you start scaling up and you get that high level of sales or that kind of a stuff, it will start giving you a break even.
Okay.
But that will only happen when you have that much of time, that much of cash flow. So you have to have a very strong visibility on what is my cash flow right now, how much I can burn, to what extent. This thing should be very clear, and there should be a sensitivity analysis for any damn thing which you are doing. What will happen at the highest level and what will happen at the lowest level. And then you have some margin of safety and you go about it. That is the only way it can be done.
Correct. So when you are talking about payback, the CAC payback periods, in the Indian fintech
Yeah,
reportedly range from 18 to 36 months for
right.
lending and wallet payments
Yeah,
players. So,
yes.
what's an acceptable range in your experience, and at what point does CAC become a deal breaker?
Yeah. So see, the way I have seen things, mainly see CAC is a word which is very exaggerated. Okay. Today, you don't even know whether these 18 months, which is there out, the number in the market, whether it is correct. No one has validated.
Okay.
How is it calculated? So it's a very good word to be used, but it cannot be a very constant or a very rigid kind of a thing. It becomes flexible, company to company,
Hmm.
people to people, process systems everywhere. But the way we are trying to see, considering a fintech company, which is a very fast moving and a sensitive thing, ideally you can say maybe 12 months, 15 months, or 18 months. That all depends on what can be the cash flow availability.
Okay.
Okay, because you will get more cash in the company if your product is good, and
Hmm.
there are investors who have confidence in that.
Hmm.
And if you have cash available and you have the confidence in your business, you can also go with a higher CAC.
Okay.
But if cash is not there, then you may have to go with a lower CAC.
Hmm.
So that's the way basically I can say it has to be worked out company to company under the all other financial and non-financial parameters.
Okay. So, how do you approach building a financial model that survives investor due to, investor due diligence, not just, telling a good story, which is
Yeah,
happening in many cases.
right. So based on my experience, the way we have always made a model has been assuming what are my past numbers, at
Hmm.
least for last 3 to 5 years. What is the real trend coming out of that? And use that with the current dynamics, make some adjustments, and you project your financials. That is the ideal way of doing it. Now, when you are doing that, what is the cash coming out? Is the business at this scale making cash? If not, then yeah, you need to raise. And when you are raising, what is the value we are looking at? From a perspective that how much is the founder ready to dilute?
Hmm.
That is the first thing comes.
Correct.
Now, how much he wants to dilute, how much control and authority he wants there in the business, and what is my cash flow requirement maybe for next 12 to 18 months.
Hmm.
Ideally, I should try to cover myself for 2 years. And
Hmm.
if then I am able to get that much of cash, that helps me under two, three scenarios that an aggressive growth plan
Hmm.
or a average decent growth plan or a very conservative growth plan.
Okay.
So those will be two, three scenarios we will build, which will require two, three different types of cash flow.
Hmm.
And then we'll try to, understand that what is there on the table for us to fix
Correct.
and go about. And that's how things will move out.
Okay.
And then you know exactly how much you can burn or what can be your CAC for a horizon of 1 year, 2 year. And because revenues may monetize later.
Right. Okay. So, like, there are studies also suggesting that over 65% of startup failures are linked to financial mismanagement or cash flow issues, not product failure.
Yeah.
So, like, how accurate is that? And what does financial mismanagement actually look like from the insides?
So a lot of companies where these things have happened, and we have heard the names also in the media of
Correct.
very good startups who have been really successful. The problem has been mainly, you can say, when an investor comes in, and if he doesn't run it like a business, a
Hmm.
shrewd business,
Hmm.
that this is the money I am giving, these are the numbers I want, and this is your horizon. That is one
Correct.
aspect of doing it.
Hmm.
Second, have very strong auditors. Auditors who are more or less aligned or in control with the investor rather
Hmm.
than with the founders.
Correct.
Because there will always be a chance to have conflicts of interest,
Hmm.
and it can be a very unbiased kind of a
Hmm.
scenario coming out. And this is where the companies have failed, where the revenues have been misreported,
Hmm.
exaggerated. There have been booking of expenses probably which have not been real.
Correct.
Then there have been investments which ideally have, so all those things have led to a siphoning of the funds.
Hmm.
This is how things have happened. Now, this is not something which is not identifiable.
Hmm.
It is easily identifiable if you really have a very strong finance team,
Hmm.
if you have a very strong CFO. The problem happens because the CFO does not have a control or a say beyond the CEO.
Hmm.
And majorly, the founders themselves are the CEO.
Hmm.
They themselves are the managing director. And the
Correct.
investor is not even sitting here, he is
Hmm.
outside. And other things I can say is that people, the team, you can say the CXO team or the
Hmm.
second line who is directly working or engaged,
Hmm.
how talented they are, how strong values and ethics they are bringing into the system.
Hmm.
What are you can say the qualities of the founder.
Hmm.
All these factors, when you see and you understand that you want to create a business for a long-term sustainability,
Hmm.
then you realize that there will be no such things happening in the system.
Correct.
Otherwise, there is always going to be a problem. And it is not a problem which can be easily solved.
Hmm.
The best is to have the right people and the right systems, processes, regular monitoring, regular audits, checks, balances. It has to be a very hardcore stuff. No flexibility when it comes to money and the compliances.
Correct. So, like, it is correct to say that these are the red flags, and
Yes.
as investors, they should avoid it, and we
Yeah.
have to take care of it. Okay,
Yeah. And more importantly, the board. You may
correct.
see that a majority of the time the board is just there on the paper.
Hmm.
Okay. And thereafter they may come out and say, yeah, I was aware and all
Hmm.
that stuff. But then why were you there?
Hmm.
It is just a formality which should not happen. And there has to be a very strong governance and compliances for the board also for each and every decision which is taken. It has to be
Correct.
minuted, recorded. The transparency has to be there 100% when you are there sitting with the money of the investor or the public.
Correct.
That's the way it has to be.
Absolutely. So, like, you have also worked with
Yeah,
startups, like, for
yeah,
more than, like, 400 crores of
yes,
revenues.
yes.
So, at what stage does a fintech need a full-time CFO? And, what's the cost of waiting for long, or ignoring that part, or avoiding it totally?
Right. So the way I have seen is that you should have a CFO once you feel that your product is ready.
Okay.
Okay. At least not before that.
Hmm.
Because ideally, when a product is getting ready, and ready, not just ready, is it really going to go and work in the market?
Hmm.
Is there a need or a requirement?
Hmm.
Once you have that kind of a product, then you have nothing to connect with what is my revenue.
Hmm.
Whether it is today zero, 1 rupee, or 100, or 100 crore,
Hmm.
you need to have a CFO. The moment your product is ready, okay, because once the business starts, all the processes, systems, your long-term planning, business modeling, governance, everything needs to set. And
Hmm.
I have worked with companies who had a revenues of 30, 40 CR
Hmm.
and has ultimately got into IPOs.
Hmm.
I have also worked with a startup with zero, first year of business operations.
Hmm.
And they have reached also a good scale of 300, 400, 500 crores of revenue
Okay.
because they hired a CFO even
Correct.
at that stage. And
Correct.
then I have also worked with the companies who have been there in the market for 2, 3, 5 years, but
Hmm.
at a minuscule revenue of 1 crore, 2 crore, 5 crores.
Hmm.
And
Hmm.
today they have also scaled up very well.
Hmm.
So CFO cost is not a cost, it's an investment.
It's an investment.
Okay. And if you do not hire a CFO with that thought process, like for me also, if I am going to work with any company as a CFO, for me it is important that whatever I am going to get my revenue or a salary, more than that I have to pay back.
Correct.
And if I'm not going to do that, my job is not going to sustain over a period of 3 months, 6 months, or a year. That's the
Correct.
way it is. So it's a business everywhere, and it's a very hardcore money there, and the expectations are huge, and you have to work very hard, very harsh decisions. That's the way it has to be.
Absolutely. So, like, there are subsectors of fintech like payments, NBFCs, wallets, fastags. So each carry different risk profiles.
Right.
So, like, as a CFO, like, how should you frame a sector specific risk in a way that builds rather than, kills investor confidence
Yeah.
or the product, or how does that happen?
Right. So see, it depends basically. Let's say, for example, a payments company. Okay. Payments require a regulator who has to give a license to that company.
Hmm.
And there are very specific guidelines.
Hmm.
Now, those guidelines needs to be the Bible for the company,
Correct.
and it cannot be only for the CFO.
Hmm.
It has to be the full for the whole leadership team,
Hmm.
and it needs to be imbibed, because when you are at a startup or you want to do a business, you may be more interested in just scaling up
Hmm.
without looking at this aspect.
Hmm.
But then the way the regulator has come up so strongly in last 2 3 years,
Yes.
now they have just made it very clear that we will not allow you to scale
Hmm.
even to a 1% level if there is no compliance and governance.
Correct.
That is how it is.
Hmm.
So if you miss that thing and you go for your business, suddenly you may lose the license and you are stopped.
Yes.
So you have to build a team. You have to have the right experts who have to create a policy process system in the organization for all the employees with respect to everything, the kind of sales you are doing, the kind of customers you are bringing, the kind of people you are bringing to work, and what are the various risk elements involved in all the stages. As much as possible, do a microscopic analysis, document that, bring experts. Let us have a very transparent audit system or a framework in place, monitoring, compliance, control. So that is one aspect, and everyone has to work independently.
Hmm.
That the way, if you see in lending, a sales guy will go and bring a customer who wants a loan, but then
Correct.
there are underwriters or a
Hmm.
credit team who is not bothered who is my sales guy and what he wants to do or what is the target of the company.
Hmm.
He will only analyze on the quality of the customer and his credit profile. And if it works or fits in those metrics within the regulations of RBI or any other regulator, then only he will approve that case.
Correct.
So that's how you have to demarcate the function. An individual department or a function has his own responsibility, and nothing should clash. Ultimately, everyone is working for the organization, and you have brought the best guys in the market to run the show. That's the way it has to be.
Right. So when you're talking about governments and regulations, RBI data shows, that NBFC, MFA gross NPA ratio has crossed 7 to 8% in
Yeah,
sub-segments
right,
across the post 2023.
right.
So when MPAs are elevated, sorry, so how do you present the credit risk story to investors without losing, into the room
Yeah,
and without losing
right.
basically?
So the way we see is that we try to understand what are the reasons why this NPA is happening, what type of customers we are having, what type of businesses they are doing. So why is the risk arise today? What are the factors? Is something at a very microscope level to tend to understand. Because when we see a NPA of 8%, there will be various subsegments who has an NPA of more than 8%.
Hmm.
And there will be many other segments who probably have an NPA of lesser than 8%, 1%, 2%, but your average is coming to 8. So you try to first target what are the high level NPAs, the highest level NPAs, and what
Hmm.
is the extent, whether it is in a situation where you can restructure,
Hmm.
or is it a repairable, is it going to work? And if that is not going to work, then somewhere you have to take those hits and start closing down those businesses, or you sell it off
Hmm.
to another, company. So
Correct.
that is the way you have to see. The other aspect is the problem. Is it a temporary problem, or is it going to be a long-term problem? Or what can be the horizon of that? And whether the company is in that situation to live with that for a period of time, because you would not like to lose the customer.
Correct.
The moment you close down the customer, he goes elsewhere, and it's a lifetime loss.
Correct.
So that also is the point because you got that customer at a very high customer acquisition cost, which
Hmm.
probably might have not been even absorbed by now. So those three, four, five parameters have to be there on the table. And this data monitoring has to be there on a regular basis. And it should not be only within the company level. There has to be a concurrent audit or an external auditor coming in
Hmm.
and giving this report on a regular basis to everyone so that everyone is aware.
Hmm.
It should not happen that only the finance guy is trying to drive
Hmm.
or push. It is there on the table, and that is the bread and butter for all the senior guys.
Hmm.
This is what is happening, and we have to take individually our areas and try to resolve those things.
Correct. So, currently, UPI has crossed 18 billion transactions
Yeah.
a month in 2024. So,
Right.
yet most payment fintech struggles with monetization. So,
Hmm.
how do you build a revenue model that makes sense to investors alongside, meeting the correct the correct work, and what's a
Yeah.
CFO's job, and
Right.
where do you fit the most, and is it underplayed or overplayed role, or how does that work into this
Yeah.
segment?
So see, there means there has been such a big buzz of UPI monetization all these
Hmm.
years. But
Correct.
has the businesses stopped or the companies have stopped getting into with the products and services or doing business? You can see so many startups keep coming on
Hmm.
a regular basis who are
Correct.
providing UPI services, collections, payments. Now, when we say B2B, I think B2B at some level, there is a profitability and a monetization model. But when we see B2C, there is a problem, there is non-monetization model. But at the end of the day, whatever the cost is factored for providing UPI services, it is to be absorbed by the end consumer.
Hmm.
And the cost of the product or utilizing that service has already factored that. Okay. But when you look at the P&L of a company, you are not able to see a revenue coming from providing UPI services, but there is a huge cost which is already sitting in the P&L.
Hmm.
So the business has is there, it is doing well, but probably you are not able to break even or make profits. So you see your P&L, you see your numbers, and then when you are having a customer who is transacting on your model, we need to see how we can leverage the customer, what other value addition products, services can be offered to the customer, or what we can do for the bank or financial institutions. It has to be on the both side. One is the customer who is receiving or paying, and the other is the merchant or a business for whom we are doing the payment transaction. So you have to leverage both the sides. You have to see how you can exploit the platform which is available. Like today, most of the companies have started becoming profitable from the angle like advertising.
Hmm.
If there is a lot of traction happening on my app or my portal or my platform,
Hmm.
can we plug and play some advertising or the data which is coming up? Is there a possibility that you use the data for monetization within the regulated allowed parameters?
Hmm.
Or can you create some kind of SaaS models where
Hmm.
you have some products which you give to the banks or the financial companies?
Hmm.
Then the best which I have seen in my career is lending,
Hmm.
trying to give lending. Like that is something which is the only thing which is profitable
Hmm.
because on the payment side, the margins are very minuscule.
Correct.
And payment is ideally not a profitable business also. It is as good as a customer acquiring model. And if you are not able to sell anything other than the payment, you are never going to prosper.
That
That is
makes
the way
sense.
it is. And if tomorrow, let's say, regulator comes up and he allows maybe 1 B, 2 B, 5 bips of revenue to the businesses on the UPI,
Hmm.
that is going to be a game changer,
Hmm.
and which eventually may happen.
Hmm.
Okay, because we were at a stage where we wanted the customer to get used to these models. And now we have reached that stage where more or less everyone is okay. Like today, if I want to, let's say I want to make a payment, a fees for my son, I have to go to the school,
Hmm.
deposit the check, be in the line.
Hmm.
There is a cost
Correct.
involved to that. But if I am doing it online via UPI, there is no cost today. Okay, but the
Correct.
cost is built for the consumer. There
Hmm.
are charges. But is this charge lesser than my convenience or the
Hmm.
time I would have spent? And after a point of time when India as a country has developed to a very good level, or you have a customer, higher paying customer,
Hmm.
you will always be able to charge them. The way you
Yes.
can say Swiggy, Zomato, today they have started charging platform fee.
Hmm.
Initially they started 1 rupee, 2 rupee, 15 rupee, 17 rupee now. And I am sure the way the Gen Z or the customer base which is getting created,
Hmm.
they will be happy to pay 25 rupees, 50 rupees. Today, if the way you may see or I may see, if I have to do online grocery or a shopping, I have to
Hmm.
go out to the market. I have to spend on the travel cost,
Correct.
the luggage cost, and I have to bring in the time. But if I am sitting at home, I was getting online free delivery. And if today the company says that I want to charge you delivery also and a convenience fee, I may pay.
Correct.
So the models have settled. It's just that how much the regulator allows
Hmm.
or the how you play. You have to
Correct.
balance it. It cannot go aggressively, and that is the reason you need to have many competitors.
Hmm.
Otherwise, it can be a serious monopolistic situation.
Absolutely. So, Hemanji, one last question
Yeah.
is like, how do you as a CFO see the fintech startup industry shaping in the next 5 years, or if we look at 2030, how is it shaping up and how is it's going to impact the industry?
Yeah. So the way I see, let's say today, if we have 100 companies over a period of 5 years, out of 100, there may be left 10 or 20 companies.
Okay.
And it's not that all balance 80, 90 companies have failed.
Hmm.
It is the success rate is improving now.
Hmm.
Okay. But at individual level, an individual fintech will not be able to survive or sustain.
Hmm.
So three, four, five fintechs coming together as a collaboration or a joint venture
Hmm.
with their different expertise products and services under one umbrella. So
Hmm.
either they come together or there are big companies who are sitting with huge cash. They absorb these companies or they
Hmm.
acquire them
Hmm.
because the business is already there, the model is there. It's only
Correct.
about your scalability, how much leverage you can take, and what is the available money to use for
Correct.
marketing, promotions, or even burning.
Hmm.
And we have reached a stage where probably we don't have to justify why a
Hmm.
fintech is required. I think that
Absolutely.
everyone is accepted. Okay, that is the next thing which has to be there forever. But it
Correct.
will never happen that the traditional models like banking, those may go.
Hmm.
But yeah, those banks will somewhere acquire these fintechs to a
Hmm.
great extent. There will be a lot of mergers, acquisitions, and cartelization, I can say.
Correct. Perfect. Hemanji, we'll move on to the next segment
Yeah,
of this podcast,
yeah,
and that's going to be an interesting one. Called rapid fire round.
sure.
I'll ask you a few questions, and you'll have to be quick in answering. It
Yeah,
can be one word or max one sentence.
I get it.
So, my first question is, if finance was a sport, what position would you play? Goalkeeper, striker, or coach?
Coach,
Okay. One financial term you wish people actually understood, but they don't.
investments,
Okay. Coffee or spreadsheets? What fuels your mornings more?
E,
Okay. Bull market or bear market? Which one excites you more
bear market,
personally?
bear market.
Okay. If you want a CA, what would you be?
I would have been a mentor or a speaker or a comedian or
Wow.
an maybe a
Okay.
modeling kind of a thing. That's
In,
more
i-
toward media,
Correct.
right?
Interesting choices. So, like a quick choose, risk taking or risk avoiding.
Risk taking.
Okay. A role model in your industry you look up to today.
I think Mr. Uday Kotak,
Int
Rakesh Junjunwala was there, who
Absolutely.
is unfortunately not there. So these are the
Absolutely.
guys. Mahindras are there. Then there are many good guys who are doing good. Yeah.
Okay. We'll move on to the next segment and you'll have to answer just one question into 30 seconds.
Yeah.
Like from a CFO's perspective, what role is AI playing in shaping what investors really look for before funding a fintech startup today?
Hmm. So AI is really making sense. Okay. From a perspective, today we are facing that a scenario where the jobs will be lost.
Hmm.
But the way I am seeing, it will happen. The jobs have to be lost, but that will happen more at a clerical kind of a stuff on
Hmm.
a immediate basis,
Hmm.
and that is necessary. People don't need to fear from that perspective because it is going to improve your efficiency.
Absolutely.
Okay, but yeah, it may reduce your earning capacity because ultimately you are doing things alone. Now you are doing it with a machine or the technology and intelligence.
Hmm.
So cost has to be absorbed by
Hmm.
both the people, both the things. Now, when an investor comes in, he wants to try to understand that what are the skill sets there in the company of the existing people, how much is the manual process, and what are the processes which can be automated, where you can use the technology and AI, and what can be the cost involved for that, what can be the time horizon to utilize or spend that, and what can be the ROI or benefit. But one thing is very clear that everyone wants things to be there
Correct.
using AI. And people
Perfect.
have also started understanding that. Means
Hmm.
I can see people are started learning. Otherwise, there were people who used to think, "Ki, why? We have done it. It's over." But no. And it's making sense. It's a very sensible thing. But somehow today maybe over exaggerated.
Hmm.
But yeah, it needs to be there and it will mature over a period of next 2 to 3 years.
Perfect. Thank you, Emerji, for your time, for the information, and sharing information which really matters to the audience. Thank you so
No,
much.
thanks, thanks. I am thankful for this opportunity and I wish everyone, you and the team and the audience all the best.
Perfect. So, everyone, let's stay connected as we continue to explore and understand the evolving world of financial technology. That was Hemant bringing his experience and perspectives into the FinTech CTO talks. Thanks for tuning in. We will meet in the next episode. Until then, stay curious, stay inspired, and keep exploring.